Hi, I'm Phil Anderson and welcome to my channel. I've been a property investor now for over 30 years and I've watched investors continue to make the same common investment mistakes. There's so many dirty tricks in the real estate industry and it's all caught up in a whole heap of sales hype. I want to cut through that sales hype and help investors avoid the common mistakes. I hope you enjoy the following content, but please remember to like and subscribe. Welcome listeners and viewers across the country. This is another episode of Street Smart Property Investing, where we take a look at what's going on behind the headlines. We'll cut through the sales hype and have a really close look at how investors can, step into the market with confidence, building wealth across the nation, and trying to avoid all the common investor mistakes. Now, we've noticed that the property market has done incredible stuff over the years to empower and protect the seller, but done very little to protect the buyer. We feel it's our role to step up and help you understand how to navigate the national property markets more safely and, like I said, avoid many of the most common mistakes. Joining me today, special guest Trent Durrington, and Trent is Guardian Property Consulting, and he does a great job of protecting investors, particularly in the task of, where to buy and how to safely navigate that space. We'll come back to you in just a second, Trent, but thanks for joining me, mate.
Good to be here, Phil.
Good on you, mate. And of course, Gordon Ruddy, Smart Property Research, and Smart Property Research is a well-known name, and Gordon Ruddy, as a property investment advisor, has a wealth of knowledge and been a close mate of mine now for 30 years or more. But the reality is that what you're doing on the ground with investors, mate, is some pretty special stuff. So it's great to have you with me here today.
Thank you, Phil. Great to be here.
Good on you. Look, let's talk right off the cuff. Let's get right into it. Today we've got a couple of big things that we need to touch on, right? We need to shed light on what the most common investor fear is. And this is a conversation I was having with Gordy through the week, and he was telling me about this, this common fear that still exists in the market. Now we want to touch on that common fear today, and we want to show you how to avoid it every time to make sure that that isn't something that's holding you back as an investor. So we're going to really make that our main topic for today. But I want to lead out. We're also going to cross over to someone on the streets. We've actually got a very, very interesting gentleman joining us today that has, I think, the largest footprint or thumbprint over probably the hottest market in Australia right now, being Southeast Queensland. He's got his finger on the pulse of so many areas in Southeast Queensland. It's a real credit to him, how much I guess he now has his, knowledge base across that sector of the market. So it's going to be great to have him here and find out what's really going on the ground in Southeast Queensland. So I'm looking forward to, that live cross with Shane a little bit later. But right off the cuff, guys, one of the big topics at the moment, and something I feel, is a trend that investors really need to understand and get in front of before they get left behind, is this remote investing trend. If you go back just to 2019, so much has happened this year that 2019 feels like a little while ago now. But if you go back to 2019, there was plenty of data that was helping me understand that almost 50% of investors were now quite comfortable investing interstate and in remote locations. There was a real trend towards this remote investing, choice by investors. But since COVID, it's accelerated. The latest data that I'm seeing, there's a great report out by MCG Quantity Surveyors, a survey they did across their database, their customers. And it found that number has risen dramatically in 2020, that now it's only about 7% of investors that are investing in their local area. 7%, and more than 90% of people are very comfortable or are investing in other locations, other states, in remote areas, many of which are hundreds of kilometres outside of their local postcode. Which brings up, Trent, from your perspective, you've got so much, your connections into the all aspects of land development. Such a big range of builders that you deal with all of the time, and you've got your fingers on the pulse across, particularly the three big East Coast states. What are you seeing on the ground, mate? What's happening there with regards to that remote investing trend?
Yeah, well, it's those investors are. A guy like me is on the hop currently, only because the owner-occupier sales for the land developments is, with the stimulus of home builder has just escalated sales. So for me trying to secure, A1 quality investment packages for the investor, it's tough. It's really tough trying to get quality land in quality estates currently because of the uptake in the owner-occupier market, nationally, but more so, specifically in those areas that are affordable, regional definitely. We'll probably touch on some vacancy rates that are happening, but that's, it's flowing through in all parts of the land market.
It's interesting because, you talk about, regional, and people often misunderstand the regional concept, right? Because if you think about southeast Queensland, and we know that for the last, say, 3 years, there's been this huge expectation that Brisbane was going to be the next market to boom. It had held back. Sydney and Melbourne have had solid price growth now. They had a little correction, then boom, back into very confident ground. But Brisbane is off the pace, right? There's this kind of vacuum that's been created, and Brisbane is very well positioned to have, a lot of growth over the coming years. And before I flip back to you, the thing that I was thinking in sort of recapturing that concept is the fact that when people think of Brisbane, when we hear about Brisbane, really for us, we don't get drawn necessarily to Brisbane. We think about southeast Queensland, and in southeast Queensland, the areas that I think are going to experience even better growth, that are better positioned for growth, are in the southeast Queensland footprint, a footprint that is bigger than the footprint of Sydney and Melbourne combined. It's a massive footprint, and those areas are considered to be regional locations of southeast Queensland.
Sunshine Coast, Gold Coast are
regionals.
Yeah.
Crazy.
That sort of reflects on last week's conversation about some key areas being, whether they be regional, there's, areas like Sunshine Coast, Gold Coast, which are an hour commute to the CBD, got good infrastructure via main road and train. So there's that section of or call it a regional area that's got the access, then it goes out to a 3-hour commute to the cities. That's also another regional. That's a bit of a sea and tree change. Mm-hmm. And then you've got some other regional towns, which is also a 3-hour commute, but they're coming into their own right, as far as population growth, self-sustaining industry, job growth, infrastructure, good infrastructure. So there's different levels of those regional towns. And people have just woken up and said, we're out of the cities.
Absolutely. It's happening, right? It's happening. Now, the big thing when we talk about the regionals is the fact that we talk about there is this, distance thing, because you do come out of Brisbane, and all of a sudden there's other city centres around Brisbane. Springfield's a city of its own these days. There's these city centres with their own, hospitals and universities and, the full retail experience, everything about it. And of course, when you go that one layer further, like you said, when you start getting even outside of the footprint of southeast Queensland, and you start looking at the bigger, cities that are, were regional hubs but are now truly cities, they're still within an hour of Brisbane because of the fact that they've got these, regular connecting flights. So all of a sudden, everybody, if you're looking at key locations, are either within an hour drive of a city office if they need to be there for a meeting, or they jump on a short flight for 45 minutes and they're in Brisbane at any rate, or Sydney, or whatever that may be.
Yeah.
It's changing everything.
Yeah. Oh, and Phil, it's not anything unusual for call it executives. I use my old man as an example. When we first moved to Queensland, it was back in '89. At that time, he was commuting to Sydney once a week. And that was, we didn't have the internet back then, But what I'm saying is, it was an easy commute then. There's a lot more flights these days. and the execs have the ability to do a lot of business via Zoom. So there's no question that all tiers of, I guess you could say, corporate management are making the move.
Yeah, absolutely. And it's certainly, you can see why investors are learning quickly that these markets are growing exponentially, and it's staggering how quickly it's turning around.
Yeah.
So let me throw a question at you, Gordon. How are you?
Great.
Thanks for joining me, mate. You're always great. You're always
great,
fit, healthy, positive, and everything's always great, and I appreciate that. Look, the thing is, as we talk, as we do regularly, because I'm fascinated by your knowledge around property strategies and your experience with holding an investor's hand through the process of matching the strategy with the properties, and then linking up my arms with Trent to go, where could we apply this strategy, this price point, etc., etc. I see you guys working with dozens of investors regularly. Can you tell me, mate, with regards to the trend of remote investing, what are you seeing on the ground? What are the investors thinking about? Is it becoming a more common thing you see?
Absolutely becoming more common. And I think it's because the investors themselves, if they are in a capital city, seeing around them how many people are realising that they can work remotely. And I think it's interesting when we use that word remotely, that we're not talking about being nowhere, somewhere that's considered, a nowhere town. We're talking, like you guys just mentioned, we're talking big regional centres with great hospitals, great schools. We focus on the areas that have got the, award-winning regional airports. We're not talking little rural towns. We're talking solid cities, as you mentioned. So I think it's just important when we say remote, we're not talking, remote where are you?
Well, we've never invested in remote areas.
No.
We were one of the few, investor kind of, teams or people that were in a similar circle that were communicating about how we felt about the mining town booms and those sorts of other trends we've seen over our 30 years of experience. And we were steering clear of it. We were getting judged back then, mate. You remember when we were getting judged about it? Now, the reality of it is that as we see, I guess, this remote investing sort of trend gain momentum, I reflect because I can remember just 10 years ago when we were talking to people in different environments about where you and I were investing, we were getting judged a little bit, right? But that isn't happening now. More than a little bit, right? Yeah. But those cities, and it's interesting because I go back over what is the performance of those locations. There's more than 100 locations that people would consider regional in Australia, more than 100 locations that have at least tripled in value over the last 20 years.
Yeah. So, mate, just to be clear, what you're saying, just for our listeners, is that when you're getting judged based on the mining boom, you guys were steering away from those towns that were predominantly driven by construction of new mines and things, where you guys
one driver. I've always had and Gordon shared it because Gordon and I have built a lot of these screening mechanisms together. It's only since you've come into our life and maybe 5-6 years ago where you started helping us understand, the real, sort of what goes on behind the scenes when it comes to how the builders approach things and land developers. And
I've taken you on some good road trips.
Yeah, you have, mate. You have. And it's just constant. The one thing about it is because we all have different interests. I'm very much into research. You're very much into, strategies for investors, and you're very much into the whole, development and I guess, understanding. You like to kick the dirt. You like to get on the ground. You like to see what's going on. You're a licensed builder. You've managed hundreds of construction projects over the years and so forth. But you're really you're fascinated, I think, more so about the looking at a parcel of land and then coming back 5 years later and there's a city there, right? That's a passion I've seen you just
Well, and it's I love watching planning changes. I always follow different council planning schemes, growth strategies. Try and track those. When we talk to Shane, I'll mention an area that I've been watching since 2004. So I get into that.
Yeah.
And part of that is seeing the shifts that happen, and it's just a matter of time.
Yeah. It is, mate. And for us, like I said, Gordy and I have been working out how to safely navigate the property market now for a very long time. And, through our different experiences and different passions, we've just acknowledged the fact that it's high risk if you're going after an area that is predominantly dependent on one industry. We've always liked the true hubs with great medical facilities, great infrastructure when it comes to, hospitals, airports, universities, etc., but with good population growth and good forecasts for population growth. And there's got to be things that drive that, right? But the reason I share it is because when we were picking those markets, people were going, you're not investing in Bondi and Sydney or some other blue chip location. And now they're looking at us going, geez, we bought one or two properties, pulled the handbrake on really, really quickly, felt like we were like this, lost our lifestyles and, went through a fair bit of pain. Whereas we've kept, I think, a model that is very duplicatable. It doesn't have to take away your lifestyle at all.
It can add to your lifestyle.
It can add to your lifestyle, which is a very different experience. And is this something that you think investors are now learning for themselves and that's also contributing to it?
Yes, that's what I think. I think people are seeing that, in these regional hubs, these regional centres, that the affordability just is... they can't deny it. They can't deny that it's affordable. We go back and we always look at the history of how these towns are performed. And when we compare them to the capital city, it surprises so many people that there's such little difference in the capital growth in these areas. But the great positive for these areas is the yield that they get. It does, like you just mentioned, someone buys in Bondi, they might have got a great buy, but it pulls the handbrake on. They feel like, oh my God, I'm committed. Every month I've got to find an extra, so many hundreds of dollars to support this. I can't really think about doing another property at the moment and just say they spent, $900,000 in Bondi, and that's costing them, whatever it is per week. They could spend that same $900 somewhere else, be in a positive cash flow position, adding to their lifestyle, using that to, that extra cash flow to pay down their, which, we've discussed that before, use that to pay down their principal place of residence, get rid of that mortgage a lot sooner, and at the same time building their asset base. It's bizarre.
It's a totally different scenario, right?
Yeah.
I actually had a gentleman ring me, a mutual friend of ours, and I won't mention his name, in the program, but he rang me this morning on the way here and he was talking to me about his, desire to buy a family home, talking about his budget, talking about what that was going to cost and so forth. But before I got to add to the conversation, had already decided that it would be much better for him to stay renting in that area because he's got, certain things that do bind him to that area. And now look at, buying an investment property in another location. And within 2 minutes of him suggesting that, I was able to say, well, this is what the numbers would look like because Gordy's telling me what other people are experiencing at the moment. And he was shocked. He was shocked that it can be so comfortable, and it just seems, it just seems a little bit different that even with interest rates being so low, that potentially people, if you're in a suburb where the median house price is closer to $1 million, that it's much easier, much more comfortable. You're still in the market, you got your foot on the property ladder. Having one or even two investment properties at the moment, it's just an unfair advantage for investors.
Absolutely.
You've seen that firsthand, I'm sure.
I am.
Okay, guys, let's cross over. I've been really looking forward to getting this gentleman on for a live cross for, some weeks now. This gentleman, I think, has the strongest personal brand inside the LJ Hooker network. When I first started investigating, teaming up with various LJ Hooker offices around the country, this gentleman's name came up so many times. And like I said, I truly mean this, his personal brand within the network, he is so respected. He's got an amazing reputation for being a great operator. No one has a bigger footprint of, involvement in the real estate industry in Southeast Queensland than this gentleman, to my knowledge. So let's welcome to the podcast Mr. Shane Colquhoun, who is the principal at LJ Hooker Narang, but has an involvement in 6 offices throughout Southeast Queensland. Thanks for joining us, Shane.
Great, thanks, team.
Go, Shane.
Pleasure to be on board.
Good on you, mate. Good on you. Look, I know that you've won so many awards. You've been respected and highly regarded for years now. What's the secret, mate? What are you doing there that's so damn special?
Oh, look, it's investing in people. As a boss of over 100 staff, we've you've got to look after them. You look after your people, and it just comes back tenfold. And I think that's one thing that I've worked out pretty early on. I did well in sales back in the early 2000s, the late 90s, early 2000s. I probably had real estate up to here, and it was probably an easy transition to probably pass on to salespeople, and probably it helped build teams.
Well, mate, good leaders always give the credit to the team, so I appreciate you, taking that path. But it does make sense because we do talk, to investors on the ground. We've got, a lot of landlords across the markets who speak incredibly highly of your team, particularly your property management team. But we'll come to that in a second. So, mate, look, you've had your finger on the pulse for a long time now. You've got your finger on the pulse of more markets inside of Southeast Queensland than anyone else, to my knowledge, as I mentioned. How was COVID-19? How did it feel?
It was a big worry when it was first on our doorstep, and to be honest, it was quite nerve-wracking. We probably went through 4 to 6 weeks of not really knowing how big this was going to become, but I think the Southeast Queensland, we were very lucky that it didn't affect us like it did interstate. And, now we look back and go, wow, there was nothing to worry about. I still think that the worry would be that if it came back, could it come back stronger? Could it affect us next winter? So there's always that in the back of my mind as to, what could be in the future. But I think we'd be well prepared to handle it if it did happen again. But looking back, COVID, no, it didn't affect us at all. In fact, I think it just sort of, it helped us just launch into an absolute massively strong market that we're seeing now.
Yeah,
better than ever before. Better than I've ever seen before.
That's interesting, mate, and that's really reassuring to hear because that's what we're feeling. So many people are talking about Southeast Queensland. So many people are focused, on the markets that you obviously service and have done a great job of for 10 plus years now. Mate, during COVID, there was a lot of fear in the investors, what was getting drilled into us through the headlines about the need that landlords would have to reduce rents and, properties were going to sit vacant. It was going to be this bloodbath for landlords. Has there been, higher vacancy rates? Have landlords needed to drastically reduce rents? Has there been any of that through COVID for you?
No, we manage about 1,000 properties across our group, and we found it was less than 2% of tenants got a reduction in rent. We might have had about 2% request a reduction in rent. We might have had about just over 1% actually got a reduction in rent. So it was really low numbers. I was expecting my property management income to half. I thought it was going to be an absolute bloodbath with regards, that property management income coming through. But when I talk a 1 to 2% effect on the income, it was next to nothing.
Yeah, look, that's interesting for us to hear because we all braced ourselves. We were all concerned, mate. You weren't on your own. My inner circle team were kind of asking what I thought personally, and there's always, I want to try to be strong for all the people that lean on me and the investors that follow me, and I look after a group of 1,000 investors really closely. So, I was trying to be strong, but at the same time, at the start of this, I was really concerned as well. I was kind of telling my inner circle team, look, brace yourself, guys. This could be, rocky for a year or two. So look, it's been surprising, and luckily for us, we put a much more of our focus into areas outside of Sydney and Melbourne, and we focus more heavily into houses than high density stock and so forth. So we kind of feel a bit blessed, to be honest with you, mate. We feel like it's kind of played into our hands, and we're seeing, markets get stronger, vacancy rates get tighter, demand rise. And
well, Phil, you've been talking about the regions for quite some time. It's nothing new in our world, and COVID's just has accelerated. Well, there has been a shift to the regions, but it's just an acceleration of call it
boosted
southern
those numbers
states.
quicker,
Yeah,
right?
Yeah, that's right. Yeah.
Yeah, and look, I think Shane sits, like I said, right in the epicenter of it all, really. I think what you're looking at the moment, Shane, is obviously a lot of eyes are on southeast Queensland, and I think we're going to see this trend for the next 3 to 5 years. It's going to be a great market for you. Vacancy rates at the moment, though, through the landlord's eyes, because that's, who most of our listeners are, the landlords that are looking at buying in your area, using your property management service and so forth, and all of those layers. What are the vacancy rates like at the moment?
Look, less than 1%. Again, managing around 1,000, we'd be lucky to have, absolutely vacant with, 10 properties.
Wow.
And it can range anywhere from 5 to 15 or thereabouts. There can always be more than that number of properties on the rental list. So that would be, people who have given a month's notice to move out, January 15 or whatever it might be. So there's always a good number there. But look, vacancy is
tight.
Probably one of the lowest we've ever seen.
Wow.
It's quite interesting with rents too. Normally in an upward trend of prices, you would normally see that rents get lower, but it hasn't happened. We've found that the prices have stayed pretty strong in sales and very strong in rentals. We had last week 100 people registered to see one property available for rent.
100 people. Wow.
100.
Wow.
That's a lot of applications to get through, isn't it?
Unbelievable. Unbelievable. Aren't you glad we're not renting, mate? Crazy
Very
times.
hard.
Crazy.
Very hard. We need more investors. That's long story short. That's what we need.
Yeah. Well, we're very excited, and you may. I know that Trent and you've been, talking about this, and there'll be a more formal sort of announcement to our listeners and so forth. We're pretty excited about some land that we believe is going to come on early in the new year, and land's really hard for us to find at the moment. But it's right in your neighbourhood and it's an area that you specialise in. So, look, I think there's, at the moment, most of the buyers, and you can confirm this, but most of the buyers that we're seeing are predominantly owner-occupiers. Would you agree with that at the moment?
Yeah, investors haven't really fully come onto the scene yet. They're starting to come through dribs and drabs, but mainly owner-occupier.
Yeah, mate, I fully agree. We've seen a huge amount of inquiry, a huge amount of interest. We've never seen this much inquiry level, and we've been doing this for a long time, but it isn't yet to translate into sales, isn't yet to translate into purchases. So from our perspective, we're kind of, I guess, a little bit concerned for the investors that it's going to be so hard to find land. We're now looking to rack our brains to go, how are we even going to find this land and these positions? But I think the good thing amongst that, in some of the ways, luckily through relationships with guys like Trent, that we're now working out how to do that, the renters are going to be right in the middle of owner-occupied estates, which is pretty exciting as well. Sales inquiry rate, is that also part of what's booming for you at the moment? Is there a huge amount of buyers that are, buyer interest at the moment?
Yeah, that's an understatement. The market is booming. I think we'll see the stats come through. I would say, if it hasn't made the news headlines already, that word boom should come through in the forefront very, very soon. We're seeing phenomenal numbers of sales. We just had, across our group, we had a record month for November, record month in Narang, record month at Coomera, record month in Ormo. It's absolutely going gangbusters.
And
volumes of buyers, huge.
And is it a mix of local and interstate? Is there anything that you've noticed as a different trend in that buyer inquiry at all?
It's still mainly a local buyer. Mm-hmm. If there was an interstate portion of it, it might have been interstate people who moved here 6 or 12 months ago, rented first, and now living. So I think, yes, they'll be classed as local because they live here now, but they were interstate 12, 24 months ago. They probably just got here in time before the COVID lockdown.
Okay.
I think we'll find the interstate splurge will go through, I would say, the first quarter of next year, once they've got the ability to come up here and check out properties. Because there's still a lot of people that prefer to touch and feel properties. They like to
absolutely
see it. And even if it is house and land, they still like to see where that land is.
The amount of time that a property's listed, it's coming down?
Oh yeah, days on market would be now. Look again, because days on market's still probably around 60 days, but that would be taken into consideration all the stock that was on the market, 3 to 6 months ago. Even some properties that were on the market 6 to 9 months ago, which we don't have many of them, but there are that old property that seems to sit there for some reason. It's generally because it's overpriced, but the market's just caught up with it. So that's what, if you look at what's listed in the last 90 days, the days on market for those listings coming on more recently, you'd be under 30 days.
Yeah, and so that it can't get a lot shorter than that because you've got to get the thing listed. People have got to, there's got to be some time involved in grabbing hold of it. I'm not surprised that you're seeing local buyers jump in because I think people are very aware of the pressure on grabbing a listing when it comes onto the market. What I'm hearing is people are becoming more aware of the need to have their finance organised and be ready to act because the market will move too quickly, and people don't need to wait and let you hold a property while you figure out whether you can get the finance or not. Are you seeing that as well?
Look, the major banks are up to around 30 days to get finance, and that's probably our biggest hurdle these days for sellers. Convincing them that it's going to take us a month to get this buyer over the line. Some brokers who are dealing with some other lenders can get finance in a week, which is amazing. But most, especially investors, most acute investors would be dealing with probably a bank or a bank that they've been dealing with for years, and they've got equity and cross-collateralisation abilities, and so they will rely on the bank they've been using for probably many years. I'm probably guilty of being that same person, but still needing 30 days, even though you might have all your ducks in a row, it still takes. There's a massive backlog of applications.
Yeah, look, I think the big message to the listeners would be that if you're looking to get into the market, in these markets that are only going to get hotter, we're looking at March next year, a lot of the lending criteria will be easing, investors are flooding back into the market, there's change, the borders are open, all of these things that are happening. I just think that there's a need for investors and homeowners to get prepared, to be prepared, get their finance organised, because stock will move too quick and it's only going to get worse in 2021. So, mate, look, it's great to have you on board. From the very first conversation that you and I had, I remember when the LJ Hooker Corporate said, this is one gentleman that's a really great operator. You should talk to him. He will understand it. He will get it. You flipped it around pretty quickly on me, and you almost interviewed me because you did. It was an interesting one because I went, okay, Shane's going to try and pick a hole in what I'm doing here because he knows a lot about the investment space. You're a passionate investor yourself. You're really passionate about protecting your database, and you do your due diligence, and some others are more worried about selling rather than what they're selling. So the reality of your due diligence, I respected straight away, and I could also tell that you knew about the investment space and you knew about the sales hype and the tricks that are out there, and you wanted to cut right through it really, really quickly. So I respected that straight away. But what has resonated from that is, that you get that there's a good thing to be established here between us, linking arms with protecting investors as they navigate, because so many of the investors are now comfortable buying in other states and so forth, and that's out of your control, but you've got a way now to protect your database. So thanks for sharing that passion with me, mate.
Yeah. No, thanks for including me and our group. Really, really appreciate it.
Yeah.
Hey, just before we start to wrap things up, Phil, I just want to come back to pick Shane's brain just around that land estate you mentioned that's coming on. Pacific Views, Shane, just being approved in your catchment only a few days ago, $3.2 billion development. As listeners may or may not be aware, it's on the Gold Coast, restrictions from the sea to the mountain. There's only so much area you can develop. This particular site's been trying to be approved since 2004. I've been watching it since. It'll have 10,000 residents. It'll be a 10 to 20 year project, but they're going to start pushing dirt early 21. So I'd imagine by March, and you talk about the loosening of lending. it's creating a bit of a perfect storm for an opportunity for buyers for that particular estate. You know much about it, mate?
Oh, look, I drive past it nearly every day. It's an estate. The whole team here at Narang has been watching, eagerly because, and as recent, obviously the news is out there with regards to the approval, the amount of them. We've lost count of inquiries we've had in this office for people wanting in that estate. The proximity to the highway, proximity to the beaches, north and south. It's, I always biasedly call Narang the centre of the Gold Coast, the hub of the Gold Coast. That specific view being right next door to us, it's equally as good a spot on the Gold Coast as any. It's a great location. Where else can you find a land parcel like that? There's the golden opportunities right there for any investors, buyers. Great location.
You think about location. Is there another location in Australia where you could think of that's within, let's call it 15 minutes drive of the beach, one of the most impressive shopping centres in Australia, all the infrastructure?
You got two there. You got Pacific Fair and Robina Town Centre. Within minutes of this estate.
Yeah, absolutely.
You got direct transport, new train, a couple of new train stations going in, probably right there across the road from this particular estate, so you're straight into Brisbane.
Probably only like 25 minutes to the Gold Coast Airport. Would it even be that far? But,
Wouldn't be
that far.
Yeah.
It could be a very special opportunity. I can't think of anywhere else in Australia that would have that mix of elements, and I think it probably will come in at an affordable level. I'll be very interested to see what it packages up at. I do know that it will be very popular with homeowners, so getting investment stock isn't going to be easy.
It's going to be tough. It's going to be tough. It'll be, I know you'll be giving me a nudge, say, Trent, where's this land, where's these packages? But we'll be working hard to get some packages for our investors.
Yeah, pretty great opportunity. Shane, thanks for, like I said, coming on board. I really do appreciate your time today. I really do look forward to giving your database a quarterly update. We're going to be doing an online national property investor update quarterly. So, look, thanks for sharing the vision in protecting investors. I really do appreciate your time and having you on board, buddy.
Thank you, and thanks again for the opportunity.
Cheers. We'll talk again soon.
Thanks, Shane.
Cheers, mate.
Well, what an exciting market that sector of southeast Queensland is, mate. It's so well positioned, for growth over the coming years. And Shane has got such a stranglehold over those 6 offices. Some pretty, interesting markets for property investors.
Yeah, 100%. It's such a desirable place to live in those markets that he's controlling, and it'll be exciting, short and medium term, 100%. Yeah.
Just being that little bit like that west of the freeway and so forth, that price point will still be quite affordable for that next couple of years, I believe. I'm going to be really interested to see what the what the package prices are as we see any stock, because stock's really hard to find in that area. It's near impossible, to come up with something that isn't, high density or other sorts of stock.
Yeah, well, it's certainly a challenge for council to forward plan their zoning and potentially keep up with staying within a 10 to 15 year plan of providing, developable land. I'm sure council right now are quickly,
they must be scurrying because there's just so much interest. So much land is being stripped out of the market. Yeah,
they have to be. This particular site, and they've been sitting on their hands for quite some time. They've obviously had an emergency planning meeting and said, councillors, let's go. We're going to get this approved.
Yeah.
The area's booming.
Yeah, it is. And I know, Gordy, you are, the clients that you're working with, there is a huge amount of interest in southeast Queensland. You're very familiar with those areas. You must be excited to hear about land potentially coming on and hopefully opportunities arising.
Yeah, very excited. And it's just so good to, that Trent's just spent so much time, researching and, speaking to the developers. And keeping us up to date with what's going on. Yeah, look, it's exciting.
When it becomes a seller's market, when it becomes a supply, compared to demand, when that ratio, starts tipping as significantly as we're seeing at the moment, it becomes very much about relationships. Otherwise, you get held to ransom for what you're going to have to pay, or you just can't get hold of the stock.
Yeah, that's right.
Yeah.
That's right. Yeah.
Look, let's get to our main topic for the day. And I know you're excited to be working with, the clients from within Shane's database, and anyone that, from our investor updates that we're running on a quarterly basis that has questions about strategies and how they could apply it, where else throughout Australia they could potentially be investing. They may already have investment stock in southeast Queensland. They may be paying too much land tax or any of those other factors and so forth, and there may be a need for them to look to invest elsewhere. So I know you're excited to share your wealth of knowledge with Shane's database. It's a great resource for them to have access to. But on the topic of investors, let's get to our main topic we wanted to, the problem we wanted to solve today. For investors that are listening, there is one really common fear that we have heard year after year after year that holds so many investors from getting into the market. And we're going to help you overcome that fear. But first, I want you to just give the listeners an insight as to what that most common fear is that you hear.
So the most common fear I get, gets mentioned to me is, will I have a tenant? Will I receive my rent every week? That's the most common fear. Because what people want to know, they're borrowing money. For most investors, it's, if not the biggest, the second biggest investment they make, in their life. And, the mortgage has got to be paid every month. They want an extra burden, so they want to know that there's going to be
reliable rental income.
Yep.
So just step the listeners through, what we've developed as systems and what you see as, when you're advising investors, would be the things that you would suggest, to help investors understand how to ensure they've got a much, much better chance of always having a renter in their properties.
Okay, number one is, when we look at a location, is we look at rather than say vacancy rate, what's the occupancy rate? We want a really high occupancy rate. Now, it's recorded, the statistics, as vacancy rate. So from an investor's point of view, anything below 3.5% vacancy rate is considered healthy for an investor.
So for every 100 properties on the market, every 100 rental properties, only 3.5 of them are vacant at that stage.
That's correct.
3.5% vacancy rate.
3.5% vacancy rate, and that's considered healthy for an investor.
Okay.
And, you and I both know, and Trent will understand, that generally those 3.5 properties that are vacant are undesirable properties. They'll be properties that are difficult to rent. That's the reality of it. And so we set as our target, if 3.5 is healthy, then we've all over the years gone, well, let's set 3 as our benchmark. In most of the markets we've been in, we want that trend to be more towards the investor. So most of the markets that we're in are 2% and below. So that's a really good formula to give an investor confidence that they're going to have their property rented. And it's not just about what that vacancy rate is today. We look back, and the statistics we use go back 15 years. So we like to look at that and go, well, what's happened over the last 15 years? Because we could look at the market today and the vacancy rate is, it could be 1%. But we go back 3 years and we see, there was a spike of 12 or whatever. Then go back a few more years and it drops down again, but then it spikes up again. So we don't want to go into markets where it's fluctuating, going up and down. And the other key thing is the right property type. Because you also find a great market, and then, without doing the on-the-ground investigations of the property manager, what are tenants looking for at the moment? What is the most in-demand property? You could end up buying the wrong property, and because of that, you don't get the consistent rent that you're looking for.
Yeah, look, and I think that's really important. So you're saying, obviously the research, and of course I know this because this is all part of our now existing systems, but for the listener, below 3% vacancy rate, preferably below 2%, and in the market today we've got some luxury situations where it's below 1% quite often, as Shane even mentioned. So a tight vacancy rate, a good trend and history of tight vacancy rates, and a trend towards population growth and a limited amount of supply coming on, so it looks like that trend is going to stay consistently tight for the landlord? And then number 3, what would be the optimal property type in that market to make sure that you are buying, the most rentable property, not the hardest to rent property? Now, it's interesting because while you were describing that, I had a thought. I had a memory, really. I had a flashback of, 2011, when every property magazine that we were opening, and there were plenty of them at the time. I don't see many these days, but everywhere you went,
there was the era of the property magazine, wasn't it?
The property magazine, right? And there was 2 or 3 very, very popular property magazines. Each of those property magazines, 2010, 2011, felt like every second page was Gladstone. Gladstone, the hottest investment market in Australia. The investors were just flooding into Gladstone. The sales teams were just pushing their, clients into Gladstone. And we'd hung back on it because we weren't fans of, the mining boom. We were worried about the fact that it wasn't as safe as we would like. It didn't have all of the structures and the usual things we'd be looking for as far as multiple industries supporting the locations. But Gladstone, we had to check it out. We felt obligated to, the people that we kind of, deal with, and the people who look to us to steer their investment decisions. And you flew into Gladstone, came back on the same day, and I'll never forget the call because you rang me and said, mate, wouldn't touch it with a 10-foot pole. Now, this is when Gladstone was booming, and it was all talk, all the people, the commentators about the property market were all very, very bullish about Gladstone. You looked at it, and the one thing that you looked at was the growth of job creation in that market, the infrastructure they were building, and you'd forecast that within 18 months, those jobs that were being created in Gladstone were going to go from the thousands that have been created down to hundreds that were going to be needed to maintain the infrastructure once it was built. Of course, 18 months later, vacancy rates went to 14, 15, 16, even 17% vacancy rates. Property prices halved. It was a bloodbath, right?
It's just where Sydney and Melbourne apartments are at right now.
It's crazy, right? It's crazy. So, look, it's a credit to you that you're not just looking to help an investor get into a property market because of what it looks like today. You're looking and you're protecting them for the future. And that was an example that came back to me. You'd probably remember that well as well.
It was the most bizarre, or one of the most bizarre experiences that I've had in property. These particular... this group flew me up there, with a bunch of other guys, and they had all the charts up of what was coming and what was spending, and as you said, they had the pop. And I thought, as someone that's trying to sell you something, why would they show you that and even talk about it? Because they literally said and showed you on the graph, here's a projection over the next 18 months. The workforce is going to, basically grow to, I can't remember the exact numbers, but
it was thousands.
It was thousands, and it grew up, and then it was
like a cliff.
They didn't actually say it, but I had it there, and you could just see in 2013 it was going from there to there, and you went, why are you showing me that?
Yeah.
I thought it was weird, and as soon as I saw that, I basically just turned off, because I went, that what they were built, the workforce to build it was, or the workforce that was going to maintain it was such a small fraction of what they needed to do it. So all the, the rents they were getting, it was all, there wasn't intrinsic value in what they were building. I mean, house prices were growing just based on the income they were projecting, not on the intrinsic value of what was, the value of a house on land at that time. People were they were paying for that income they were going to get from the tenants that were coming in, and you just knew that once that was gone, first the rents would halve, and property prices literally halved from what they grew to over that kind of 18-month period. And I'm just so fortunate that we never got involved in it.
Yeah, look, it's a sad thing to see people see one dimension of property investing, and maybe that's their only experience they ever get. And I'm really glad that you were you saw through all of the other bits of hype to be able to see exactly where the cliff was, when it was going to come, and let's go not go anywhere near it. Trent, what you would do is you'd normally identify, the markets around Australia that are, obviously incredibly appealing. We've identified the markets that we believe are set to boom. But what would be the next step? What would be that next step to help investors feel, much more confident about what they're targeting is going to attract a good quality rental demand?
Yeah, I've got my way of doing it. I guess we all talk about property in those areas. Phil, you'll mention a town or an area, and we'll do some further research. Once we get into that point, then it's approaching someone like Shane. He's got 1,000 landlords or properties on his rent roll. Straight away, he's the guy. His team knows what's the demographic, what's the tenant looking for. Is it a 3-bedroom with a 2-bathroom and a double garage? Is it a 4-bedroom? Is it a family of 2 kids? Whatever that might be for that particular suburb, he knows it. So first of all, I find that configuration and say, okay, well, it's a 4-bedroom, 2-bath, double garage. They're probably only going to pay about $500 a week rent. So it's a bit of a reverse engineer. Then get on the ground, try and find the most desirable estate. There's no secret that we look for the high owner-occupier estates. I get a feel, drive through, see what relationships I've got, 1 with the developer, 2 with the builders, see how I can get packages to match that criteria, and pull it together that way. Occasionally, there may be a little bit more level of investment, but that might be on a smaller development that's surrounded by predominantly owner-occupier houses, and it comes together that way.
It's interesting because I know Gordy's coming from the perspective of what's going to be the best strategy, what's that price point, what's going to help an investor meet a target in a certain timeline. Then when that sort of, goal is created and that, picture of a price point and a strategy is presented to you, you start thinking about what markets around Australia are at that price point, but how you get to that, confidence level is by interviewing the property managers. They, like you said, they know firsthand what's going to be the best properties in that market, what's going to attract the best quality tenant, what is going to be the real, rental position, And yet so many investors start with the property. So they go and find a property that they want to buy, have no idea really whether it's the right property to target, if the numbers are going to work out. And it is, like you said, it's reverse engineered. You would know from the perspective of the agents or the property manager's perspective as to what's going to be the best rental property in that market, because they also want a great experience. They want to have great quality tenants that they're dealing with.
Yeah.
They want to have high demand. They want to have happy landlords.
Yeah.
So it's a perfect fit, really, for everybody.
Yeah, it is. It's just, the rule of thumb I tend to use is a $1 per 1,000 generally gives you a 5% gross yield. So if a property manager says, well, look, people are prepared to pay about $500 a week, I straight away say, well, I need a house and land package worth $500,000. For a landlord to, these are rough and they'll vary, but to achieve a 5% gross yield on a typical house and land package.
And I guess you start getting concerned if those packages are $750,000.
Well,
you go, the numbers are never going to work.
Doesn't work.
Yeah, and it becomes a very mechanical process. But at the end of the day, it's a vehicle to create wealth. It's not something to get emotional about. We all love being very house proud of what we end up with, and no one loves a better finished property than what you love. You have very high standards on what property, the quality of the property that the investor is purchasing at the end. But to get to that point, it's got to make sense.
Numbers. It's all about the numbers.
Yeah. Look, I think that's a really important thing for the listeners. That fear of not being able to attract a tenant can certainly be eradicated. I can't think of the last time I had a vacant property.
No.
It's bizarre, right? The only properties, if I ever have any concerns around the renters or the leases is when I start dabbling a little bit in the commercial or industrial type stuff. I've got, blocks of units and properties that have got commercial spaces underneath them, units above, different properties in my portfolio. And it's the commercial leases that tend to be the things that I've got to always be negotiating and be a little bit concerned about, whether I'm going to have a tenant or not. But residential-wise, I can't remember the last time that I had a vacancy. And maybe that's a lot to do with starting with the right property in the right market.
Absolutely.
Yeah. Look, guys, let's answer a couple of questions before we finish up for the day. I think that'd be a great way to, to end this podcast. Let's, Trent, there's probably a great one here for you that Brendan gave us last week, because we talked a little bit about the rising, demand on land and land values and so forth. His question was with regards to what size of land, you should be targeting at the moment. And we all know that land's getting cut down smaller and smaller. Have you got any thoughts around what, amount of square meterage or, lot size that you should be targeting as an investor?
Yeah, look, well, that varies from state to state, from council to council. When I'm exploring future urban growth strategies and what the planning's looking like in the future in the 5, 10-year and 15-year forecast, councils are trying to up the density. So what does that mean? They want, the last plan in a certain area I read, they want 40% of all future greenfield development. When I say greenfield, that's land. 40% of that to be multiple dwelling. So whether that be a townhouse type development or dual occupancy, whatever that might be. So what we're seeing is that they want more growth around the urban areas. To achieve that, the land component's got to get smaller.
It's interesting because I have reflected a few times, and Australia has the biggest houses in the world. Australians, we don't realise we've got the biggest houses in the world, bigger than America, right? The biggest houses in the world. And if you go back to the traditional, quarter acre blocks and so forth, and many of those, older suburbs and so forth, where we've got these big blocks of land, and people talk about Australian housing's unaffordable. The reality is the way that we've planned many of those older suburbs, it really is like one of those houses. Really, if you're in the UK, that would be the equivalent of about 5. That's the problem. You get to somewhere like Hong Kong, it's the equivalent of about 20, right? So it's a very different thing depending on where you go. So it makes sense, as much as people may be reluctant to accept the fact that lot sizes are getting smaller at an international level. Man, we are blessed with how much, the space that we have around us and the allotment of land that comes with most of the properties. But I can understand why councils are starting to go, you know what, we can't continue to do this. The sprawl of our cities is going to be too big. We need to bring these, the lot sizes down, and we need to keep up with demand.
Yeah. But on the flip side of that, lots are getting smaller, but under the current urban planning, and I'm going through it with the site that I'm part of now, our smaller lots, we focus those sort of lots around open space. So they may back onto parks, have access to walkways, all those sorts of things. The larger lots, not so much because they're self-contained. So there's a lot better urban planning on a macro and on an individual development scale than there was before.
That's a really good point, because I've seen you target specific estates because you've said, you know what, our investors, they want the beautiful landscape, they want to drive through the estate and it doesn't feel like it's a rental community. They want this feeling of being the better quality tenants want to be amongst beautiful family homes. You want to have that whole experience as a renter, as a landlord, as an investor, but and you want to have give your tenants a chance to not have these huge lawns to mow on the weekend. They want the upkeep to be practical. You want to make sure that your property's easy to maintain. But there's so much development now that really does lend itself to still having a great lifestyle, beautiful walkways and parks and so forth. It is pretty special when you get into the sort of estates that you have those close relationships with.
Yeah, no, that's right. Gone are the days of a master plan community where you've got 1,600 square metre lots. You've got to cater to a whole range. It's we hear it all the time about affordability. It's government are driving affordability, and you've got to have a range of products in those estates, which exactly is just what you said, mate. It caters to a whole range of tenants and homeowners.
Gosh, each pocket we delve into, there's such a deep pool of layers we could continue to go through. But that's good, and hopefully Brendan gets some perspective there of the fact at the moment, as far as sizes goes, don't expect the quarter acre lots as a size. Do you think on average at the moment is it averaging out at 400 square metres, 350 square metres? Is there any rule of thumb? It just depends on the councils in the region.
Queensland's still bigger than the southern states.
Uh-huh.
Melbourne's getting smaller.
Mm-hmm.
Melbourne is bigger than Sydney, but
Not much.
if you put a ring, an onion ring around moving out into the suburbs, the closer to the cities, obviously the lots are getting smaller. They're getting a lot.
Sure.
It's a lot denser.
Yeah.
I could come back to Brendan maybe on another podcast and give some real numbers around
Maybe
that.
we should do that.
And
I think it'd be
look at
interesting for us to really delve into that a little tiny bit.
That'd be good to show that and show the averages over the last 15 years.
Yeah, let's do that. Let's do that. Gordy, I've got a question for you, mate. There's been so many questions that keep coming back ever since you mentioned self-managed super funds. You know that it's my favourite investment vehicle. The question we got from Quentin was with regards to the numbers around self-managed super fund. How much does it take? What sort of deposit do you need? Real basic overview. And I know we're going to do a very special podcast we've already started organising, but just to give Quentin a quick recap.
So the exciting thing about the self-managed super fund is the purchasing of a property in self-managed super fund is the leverage around your super. Now, I've got to be very careful. This is very general, and anyone who's considering it needs to obviously seek professional, financial advice on it. But what we've seen through our investors who've taken this path is what they can do with the funds in their self-managed super fund. So, for an example, I'll use a real example. So, one of my clients, Zane, his property's just finished. They're just going through the last stages. The OC was issued last week, so they're just finalising the
OC for the listeners, Gordy.
OC for the listeners is occupation certificate. So that means that the building's completed. The lender can now finalise the loan documents and proceed to settlement. So their particular property was a $395,000 property. So they had just on $200,000. I think it was just a little bit less, about $193,000 they had. The banks generally want you to have about 200, but that's where you go and you see a financial planner. They'll do a statement of advice for you. They'll look at your situation and they'll give you advice on whether that's an appropriate thing for you. So in their case, it was an appropriate thing for them to do. So of that $193,000, they used for the deposit and all the costs to get in, to set up the self-managed super fund, to pay their stamp duties, pay everything. It was about $165 of that $193, so left them about $30,000 in their self-managed super fund. So they used $163,000 to purchase the $395,000 property. The exciting thing is they used $163 to purchase, for round figures, let's say a $400,000 asset. That $400,000 asset over the next 12 to 15 years is going to pay itself off within itself. So they're not needing to put any money in from their own personal funds. That'll pay itself down. And we're always conservative.
So they'll own the property outright
they'll
in
own the property
12 to 15 years.
12 to 15 years, they'll own that property outright without using any personal funds.
Mm-hmm.
That in itself is great because you go, well, there's a $400,000 property has turned into, for round figures, $800,000 in that, 12 to 15
years. Yep.
15 years, we go, wow, that's pretty cool. But it's not, they didn't invest $400,000. They invested $163,000. The gap that the bank funded, the property paid that off. They didn't have to put extra money into that. So when you look at what is the real return on that $163,000, I should do the numbers on that because that's a lot better than a 5% return on their investment over that time. So,
but
it's just amazing.
Someone strategizing for that and looking at, okay, when I retire, I need $2,000 a week. There's $800 if it's still getting 5%.
Correct. Correct.
Yeah.
Yes.
So it's 50% of what they're target, at $2,000 a week retirement.
That's one.
Yeah.
That's one investment decision that they made.
Yeah.
And if their decision at that point when they retire is to sell that property, I know you love this one, Phil. What happens?
Well, what I would say is you hit that button, go into retirement mode, and then you can sell that property, and whatever that property's worth, you own it outright, and when you sell the property, there's not 1 cent to pay in capital gains tax. It's yours tax-free. Now, that's made this particular opportunity of using your super and, through a self-managed super fund buying property, my favourite investment vehicle by far. So, mate, I'm excited about it. I know that we're going to have a very special guest on the podcast next week. We're going to make the next podcast just about buying inside of a self-managed super fund. I'm very excited about having Peter join us, and we'll have a great chat. For the listeners, please know that we were going to pull it apart. We'll give you some great insights as to, why I think everybody should be at least investigating if they have the ability to buy using a self-managed super fund. Look, guys, another great podcast. Thanks for joining me. I know there's so many layers of where we could go and so many topics to cover.
Yeah, we seem to get down some rabbit holes, but hopefully the listeners are enjoying it and it's educational.
Well, mate, there's plenty of great stuff there. Your wealth of knowledge and Gordy's experience with dealing with people every day, and obviously the combined benefits of people wearing all different hats. I think there's some really great stuff here to share. It's only new. We're only new to this podcast kind of format, but I think we've got lots of great ideas as to how we're going to make these better and better as the weeks go on. So thanks for joining me. Like I said, next time we come back with the next episode of Street Smart Property Investing, we're going to be focusing on everything to do with buying property inside a self-managed super fund. Thanks to the listeners and viewers at home, and we'll talk again soon, gentlemen. Thanks for joining me.
Good on you.
Thank you, Phil.
Thanks for watching, guys. Don't forget to subscribe, and also feel free to leave me a question. I look forward to helping as many property investors as possible. Take care, and we'll talk soon.